What's up? What's up? What's up? Let's see here. All right. So one of the reasons why I decided to jump on the live real quick just to give you guys a real update about this 401k argument, because a lot of people is not taking the time to learn how to manage their money, and it's very important for you to learn how to manage your money so that way you can stop losing it. And I'm listening to a lot of people, and I realize that they're not giving people the most correct information or the better understanding. So what I'm gonna do is that I'm gonna break it down to where it's so simple. You could see this, you can replay it, you could share it to somebody, you could tag somebody, and it's gonna be quite easy for you to definitely understand how to manage your money and why it's important for you to understand these things about 401ks and 403bs, 457s, IRAs, stocks, all these different things, right? So when it comes down to money, I'm gonna just get right into it. When it comes to money, right? There's three ways your money get taxed, right? And when you need your money, these three ways you got to understand how they work. Because in the tax now column, right? When you need your money, like everybody got to pay tax across the board, no matter what. I don't care who you are. You're going to always pay taxes. Until they change that law, that's where it is right now. There's no way around it. And every time you try to figure out a way around it, they're going to get you. So the three ways your money get taxed when you need it is now, later, and never. Okay? Let me say that again. The three ways your money get taxed when you need it is now, later, and never. And that's one of the best kept secret. I know you guys are looking at me like, never. Yes, there is a way that your money don't get taxed at all when you need it. And many people didn't tell you about this part. And that's why I want you to pay very close attention to what I'm about to tell you right now. So the first way, now, that means your money is called taxable money. Okay? That means your money is taxable. And taxable money is in your checking, your savings, your stocks, mutual funds, money market funds, certificates of deposit, which are CDs. These money are taxable money. So any earnings from these money in the year, you have to report it and pay your taxes on it. So any earnings in these accounts, you have to report it to the IRS and pay taxes. Okay? So that's taxable money. There's over 85% of the population that's inside of these vehicles. 85% of the people have money in a taxable vehicle because everybody have a bank account. Everybody in a bank account, and they have to pay taxes. How about later, right? They said they're going to tax me later. Let me break down what tax later mean. Tax later mean that your money is also called tax deferred. Tax deferred money is IRAs. They're also known as annuities, pensions, 401ks, 403bs, 457s, and things in those nature. These vehicles are called tax deferred vehicle. Now, tax deferred is pre-tax money, and what pre-tax money means that the money that is not taxed yet. Okay, you didn't pay any taxes on it yet, and this is what pre-tax money does. Once your money is pre-tax, right? They have a whole bunch of rules that come with these type of vehicles. They said that if you touch the money before 59 and a half, you will have to pay a 10% penalty with an addition to taxes, right? And if you touch the money at 59 and a half, you don't have to worry about paying taxes, but they're going to tax you. No, you don't have to worry about paying the fee, the 10% penalty fee, my correction. But you will have to pay taxes, all right? You'll be taxed as ordinary income, all right? Taxed as ordinary income. Also, you can't keep money there forever. You must start withdrawing the money before you reach 70 and a half, or you're going to pay a 50% penalty, which is called required minimum distribution. You fail to take out the required minimum distribution at 70 and a half, and you would have to pay 50% of your money in penalties because of that. These vehicles are also known as retirement plans, right? How come no one didn't tell us about these rules? Why no one didn't tell us about these rules? Did you know that when it comes to retirement plans, they break them down in two different categories? It's either a defined benefit plan or it's a defined contribution plan. Did you know that a defined benefit plan is called a pension? And the reason why it's called a defined benefit plan is because you know what you're going to get when you retire. Because it's calculated based on the amount of hours you work and the amount of salary level you have. Did you know that your defined benefit plans will allow you to enjoy your retirement until you die, and even some case the beneficiary will continue receiving it? Isn't that powerful? So why is it that your companies don't offer you pensions? But what they did was replace them and get rid of them and replace them with something called defined contribution, which was created less than 30 plus years ago. Uh-oh. All right, I'm back. Right? So this is what happened. Your defined benefit plan is pretty much was the best way that was created for baby boomers to make sure that they never run out of money in retirement. But then they created defined contribution plan, which was actually founded by a gentleman named Ted Benner. Ted Benner found out about the tax code 400 because it gives it gives the employers a tax write-off. Right? It was another way to get a tax write-off. And what they did was every time their employer put a person in the defined contribution plan, and if they match them or give any money into it, it was another way for them to have tax write-off. That's why your company started matching you. It wasn't because they like you. And it's another way for them to actually get more tax write-off by enrolling you in it. Because it's considered as a company's expense to have you sponsored. That's why they sponsor you it. Did you know that defined contribution is also known as the IRS tax codes? These are IRS tax codes that let them know that you will be pre-taxed. You'll pay taxes later on. Did you know that contribution limits are set every year to adjust to the high cost of living, which is also known as inflation? Did you know that you can't put as much money as you want in there? There's a limit to how much you can put into these vehicles. Do you know why they call it defined contribution? Think of the word contribution. Think of the word defined benefit. Defined benefit means that you know what you're going to get. Defined contribution means that you know exactly how much you put into it. But you will be unable to know how much you're going to get due to the fact that the market fluctuates. It doesn't matter. You don't know what the market's going to do today or tomorrow. So it's unpredictable. Here's another thing. You don't know what taxes will be later on. On top of this, it comes with management fees, all kind of hidden fees, right? So this is my thing to you. If you can't predict what taxes would be later on, and you can't predict what the market would do later on, how can you predict how much money you're going to have for retirement if this is for a retirement vehicle? These are things you got to start asking yourself. And you got to start wondering what is a better way out there. That's why they have the tax never when you need your money, and no one ever tell you about that one. Did you know that tax never is also known as tax advantaged? And tax advantage vehicles are like Roth IRAs, 529 college savings plan, right? Life insurance, right? Long-term care benefits, municipal bonds. These vehicles is where your money don't get taxed when you're taking it out. But here's the thing. Let me go down the path. Let me go down a little road with you and explain a little bit, a few things that they didn't tell you too. Did you know that within a Roth IRA, you actually can keep money there forever, right? But here's the thing. There's a limit to how much you could put in there. And it still comes with the rules as if it's tax deferred, which means that if you put your money in a Roth IRA, you can't touch it before 59 and a half. And right, you can keep money there as long as you want, but you can't touch it before 59 and a half. And if you do, the same thing, right? So these things are little rules. You also can't touch the money for the first 5 years in a Roth IRAs. Did you know that? From you put in the first contribution, you can't touch that money until 5 years later. So here's another thing. 529 college savings plan. Did you know that the 529 college savings plan can affect a family's eligibility for financial aid? Because when you fill out FAFSA, it asks you for things like what stocks, right? How much you have in the savings, how much you have in the 401k. And if you have a 529, you got to report how much is in it. And based on what you tell them, then they determine if you need financial aid. So you could actually hurt your kids. That's why it's important for you to learn these things. Right? Did you know that life insurance? Did you know that the IRS, the Internal Revenue Service, their guidelines give many favorable tax advantages to life insurance? Did you know that you get tax-free death benefits? Which mean that if something was to happen to you and you pass away, and if it's structured properly, you should have 10 times your income in place if something was to happen to you. Your family will not only get the 10 times your income, which is known as a death benefit, but they also get the cash value that grew in this thing. Did you know that you get tax deferred earnings in life insurance? Did you know that you don't pay taxes on the gains? You also get tax-free withdrawals and tax-free loans. Did you know that some of the great perks about life insurance that many people never tell you about is the fact that within life insurance, you actually get protection. Your money is protected from lawsuits and garnishments, and divorce and child support in some states. Did you know that? You know what isn't? Your 401k, your house, your bank, your stocks. All these things are considered assets. So if you do get a divorce or you get a lawsuit, you're subject to get garnished or even lawsuit against them. Life insurance, you can't. How about the fact that it's a great emergency fund? Because there's no age restrictions. And the fact that you have access to your money without no 59 and a half, and you can keep money there as long as you want, whereas there's no age restrictions about 70 and a half or RMD. How come they didn't tell us this? How about the fact that it's a great retirement supplement because you get tax-free withdrawals and tax-free loans, and on top of this, you don't have to pay taxes on the gains. And if something happened to you, it's a great way to pass it on to your family tax-free. How about the fact that they never tell us about it? It's a good way to save for our kids' college. It's a great way to save for our kids' college because it's the fact that you could grow this money at a very high interest. Did you know that if you put together the right life insurance, you could actually earn up to 15% in this? It has a cap at 15% earning potential, guys. And it has a floor that you never lose money at 0.75%. Did you know that? How come they don't tell you this? Did you know that's a great savings? Did you know it's a great savings because the simple fact that you have the ability to protect your money and you have the ability to earn up to 15%? Did you know that in the past 20 years, the market have given a return of 8.03% in the S&P 500? Did you know that in the global index it's been 8.64%? So right across the board, it's been about an average of 8% in the past 20 years. How come no one didn't tell us this? Why no one didn't tell us about this? This is the things that you got to understand. How come no one didn't tell us about the 10-20 rule? that we need to have in place 10 times our income so that way our family don't suffer if something happens to us? How come they didn't tell us that by time of retirement, we need to make sure that we have 20 times our income in place if God forbid something happens? These are things that we have to make sure that we plan for and prepare for. Because if we don't plan for these things, we're going to always be in trouble. A lot of money trouble. So you got to take the advantage and learn these things and understand about managed growth. Because there's 4 important things that you got to understand when it comes to your money. You got to learn that a lot of people want to learn how to grow their money. And that's how you could do it safely. A lot of people want to make sure that their money is safe. They don't want to lose their money in 2001 and 2008. You got to understand that tax advantages on your money is very important. And you got to make sure that your estate can go to your family tax-free without worry about probate. These financial knowledges is very important for you to take in. This is why I encourage you to enroll in our financial workshop. I encourage you to click on the link in my bio. And let's get you enrolled in our free financial workshop. Because it's important for you to learn these fundamentals. It's not hard. And the good thing is, I have a free book for you. A book that's going to enlighten you and put you in a position to learn. It's time you learn so that way you can earn. Alright? So always like I said, my name is Keon Corniff, also known as Mr. Finance. And just remember that you're one decision away from changing your future for the better. I'm here to empower you and give you the knowledge that you need to learn to become your own money manager. It's time you trust yourself. Don't trust nobody else but you. You have a blessed night, alright? Bye-bye.